Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. Now, we got a great show today. We're going to be bringing back one of our favorite guests, Mr. Paul Moore. Now, after a stint at Ford Motor Company, Paul co-founded a staffing firm where he was the two-time finalist for Michigan Entrepreneur of the Year. After selling to a publicly traded firm, Paul began investing in real estate. He launched multiple investment and development companies, appeared on HGTV, and completed over 100 commercial and residential investments and exits. He is the author of the best-selling book, The Perfect Investment. Let's welcome to the show, Paul Moore.
Hey, John, it's great to be here again. How are you?
Absolutely. Hey, Paul, it's great to have you back on the show. You were a guest all the way back on episode 154. So it's been a while since we've talked to you. For those folks who aren't familiar with your story, your background, why don't you take 2 minutes and fill in some of those gaps?
All right, great. Well, like you said, I sold my company to a small public firm in 1997, and I thought, hey, I'm a full-time investor now. And I went out and proved that I wasn't. I proved that I was a full-time speculator now because I didn't know the difference between investing and speculating. I've concluded 20 years, 25 years later that investing is when your principal is generally protected, or it should be, and you've got a chance to make a return. And speculating is when your principal is not at all safe and you've got a chance to make a return. More specifically, speculating is when your investment or your principal is not tied to an income stream. And what I learned over these a lot of painful years, John, is that investing should have a goal of building true wealth. True wealth is when you have assets that produce cash flow. And speculating, you're investing in assets that typically don't produce measurable, predictable cash flow. And there's nothing wrong with speculating in things like Bitcoin and such. I have a little myself, but it's important to know the difference and to know that, your chances of building true wealth are probably in more boring assets that grow slowly over time. Warren Buffett told Jeff Bezos, nobody wants to imitate Berkshire Hathaway because no one wants to get rich that slowly.
Hey, I love that, Paul. You talked about, one, selling your companies, making some money there, and then realizing that you were actually a speculator more than an investor. And you talked about the difference, right? And what I wrote down there is that being an investor really comes down to having your principal investment protected and protected through a revenue generating or an income producing asset, as opposed to just hoping this thing goes up in value. You kind of alluded to cryptocurrency, but some other assets. Can you help us just understand how you reach that conclusion? Because that's so much, just wealth of knowledge that you obviously experienced. But, when you go back and rewind the clock, it probably seems obvious today, but why did you miss that then? I mean, what was your approach back then, and how did you kind of miss that approach?
I think it was because I was chasing shiny objects. I've concluded, John, that I was an entrepreneurial investor. And here's what I mean. I was not even 34 years old when I sold our company. And I was bored. I wanted to get the same thrill, the same charge, excitement out of investing that I got out of running a business, doing a startup, having all that excitement, of, all the new stuff that's thrown at you when you have a startup. And I was wrong. I didn't realize, that investing should be boring. The first Paul Samuelson, the first Nobel Prize winner in economics from the US, said investing should be like watching grass grow or watching paint dry. If you want excitement, take $800 and go to Las Vegas.
I love it. Investing should be boring. That's a great quote right there. Talk to me about the book, right? So you kind of went through this process. You're the author of The Perfect Investment. I know we've talked about that in the previous episode, but for those folks who aren't familiar, what exactly is that book about?
Yeah, the book was originally titled The Definitive Guide to Multifamily Investing. And I had a friend who read the book and he said, that title's boring. It's going to sell a handful of copies. Why don't you get a more provocative title? And he said, didn't you say in here it really is the perfect investment? And I said, well, yeah. And he said, well, why don't you call it that? And I humbly agreed to call it the perfect investment. And, I found out something. I found out as we got into, 2014, 15, 16, 17, the perfect investment is not perfect. I published the book in 2016. Um, if you have to speculate to get there, if you have to
Mm-mm.
take what should have been a safe, relatively predictable investment, and you have to speculate. And how can you speculate? Number one, by using risky floating rate debt. Now, I know I'm stepping on some toes there, but sometimes the only way to get the deal is to stretch every bit of your underwriting, and you get the floating rate debt, and then you assume, and of course we didn't know how bad inflation would be back in the late teens, but assume that you're going to be able to continually drive operating expenses down while increasing occupancy, and assuming that trees would grow to the sky this one time. And that means specifically that you're able to continually raise rents 5 or 10% a year indefinitely. One of the arguments I heard is, rents in Tucson have gone up 12% a year for 3 years straight. We're only assuming an 8% increase the next 5 years. And I was like, wait a minute, um, so just a mindset which is sort of entrepreneurial again, that says everything has to go right to make this work, but I'm willing to do it because, as a very, very famous multifamily investor syndicator said publicly, just get multifamily. It doesn't matter if you have to overpay, just get in. And it was like, so people were doing that. The problem, John, is our little new syndication company in the mid-teens had to compete with lots of people doing that. Lots of people who really believed trees would grow to the sky and that somehow they could keep, just rolling the dice and doubling their investors' money every 18 months. And so they were willing to, overpay in many cases. So we were underwriting these deals going up against people, that were paying 10, 20, 30% more than we thought was prudent. And we had a goal. And the goal was to be, as all of us should have, if you think about the 80-20 rule, you should want to be in the top 20% of the operators and 20% of the investment opportunities for your investors' sake. We didn't think we were going to get there because, we had a small track record, a small, inexperienced team, and we just thought, well, how are we going to get there? How are we going to get there when we can't even close on a deal because so many people are overpaying? And there were ways to do that, but it was tough. So we pulled back and said, wait a minute. We also want diversification as investors ourselves. I want to be diversified across different geographies, different asset types, different strategies, even different places in the capital stack, maybe debt, equity, mezz debt, preferred equity. How was I going to be able to do that when, we could barely even get one deal in one asset class in one city? So we realized, if I was an investor, I would rather invest in a diversified fund, diversified across all those different types of assets. But we realized there's no way we're going to be in the top 20% of the operators in 5 different asset classes like self-storage, mobile home parks, RV parks, light industrial, multifamily. And so we pulled back and said, okay, let's just create a fund. So we're about to launch our 7th fund. And these funds are basically our goal. And this is our one big desire here, John, is to go out and find the best of the best experienced operators with the safest deals that have, good upside, value add typically, and put them together in a fund. So investors could give us, for example, $50,000 and get a piece of maybe 100 different assets from maybe 20 different operators. So that's what we do. And that's how we've kind of come back to saying, this is how we're going to operate in the world. And somebody who wants, who's willing to pay us to do that due diligence and hopefully pick not only the top 20%, but our goal is the top 5% operators in any different asset class with these great deals. Our theory is that we could produce outsized returns and, more importantly, protect their principal by this diversification plus due diligence strategy.
Paul, I want to play back some of what you said because I think it's really important for people to process how you got to where you're at today, right? And first of all, you talked about the perfect investment. You take the time, you research this book, maybe get your arm twisted a little bit to name that book the perfect investment, but you believe in that theory. But there was a flaw, and you said that the perfect investment isn't perfect if you have to speculate, right? So to reach the returns that you need in order to get these deals done, you would have had to make some speculation on what the interest rate was going to be, what the business plan was going to be, the rent growth, things like that. And that made you guys uncomfortable. So you weren't able to do as many deals. The other thing was, and you kind of took a little jab at, one of those big time syndicator guys who talks about, hey, just get into multifamily. Who cares if you overpay? Which, again, huge fallacy. I don't know why people would ever do something like that. Well, I know why they would, but it's really risky to take that approach. So you said, hey, if we can't be in the top 20%, maybe we need to think of a new strategy. And I think that's really important to just stop and process for a second, because it's easy just to keep doing something and say, "Oh, okay, whatever, we'll be okay. It's okay to be mediocre," right? You didn't want to do that. You said, listen, if we're going to do this, if we're going to work with other people, we want to make sure that we can deliver an excellent experience for them. We can deliver outsized returns. Why don't we step back instead of trying to do all this stuff ourselves and trying to be a mediocre operator because of just the deal flow and whatnot, the inability to scale based on what we're seeing in the marketplace? Why don't we focus on the fund side? In that way, we can cherry pick deals. We want to work with best in class operators. We want to diversify based on asset class, based on our position. Maybe some of these deals are debt, maybe some of it is preferred equity, maybe some of this is equity. But now we have a chance to really figure out where we make the most sense and where our investments make the most sense. And we can diversify our investors' investment. So for that investor you're talking about, instead of them putting 50,000 in one deal, that 50,000 is now spread across multiple deals in this fund investment. Can you just talk a little bit more about the fund structure? Because, people have heard funds and investing in funds. And I think where people get tripped up is now trying to figure out, well, what's different between investing in a fund like Wellings Capital offers versus just going on the stock market and buying a real estate mutual fund or something like that?
Yeah, so I'll take that last comment first. If you're going out to, let's say, invest in a public REIT, which is on the stock market, you're beholden, often beholden to the mood on Wall Street, a war in the Middle East, a CEO scandal or random tweet. And, it's often not, there's not an easy way to connect between the performance of the asset on the ground and the actual value of my investment. Because, I mean, if the market goes way up or crashes, it might not really have that much to do, the value of my investment might not have much to do with the fact that the property manager is driving increased occupancy, higher rent growth, lower expenses, etc. So that's what I would say about that. As far as the way the fund is built, it's like a lot of other syndications, John. There's a preferred return, which means the investor typically gets the first 8, 9, 10% of the cash flow. And then, for example, an 80-20 split above that. So it's got a very typical waterfall. The difference is investors have, they get this diversification, which, like you said, means they're getting a small piece of a lot of hand-picked projects and operators. But the difference, the downside for investors is they're going to have to pay a double layer of fees, meaning, we're getting a preferred return from the operator, which effectively, if you think about it, sort of flows through us to the investor because we're getting and giving a preferred return. But then on top of that, that 80-20 split, an investor might think, wait a minute, Wellings Capital's getting an 80-20 split. I'm getting an 80-20 split, so I'm really only getting 64% of the upside. And that's absolutely true. However, number one, we're getting better terms than most investors. Sometimes there'll be a 60-40 split available in the marketplace. We're getting 80-20. Secondly, um, we are also getting deals that they couldn't get access to. Well over 50% of the deals, probably 60-65% of the deals in our last fund were handpicked, like were literally designed by us, for our investors. So they were, for example, on a $50 million multifamily deal in Odessa, Texas, there was 30 million debt, 20 million of equity, if I recall, and we were bringing 15 of that 20 million in equity, and then the rest was put in by their friends and family. So it was not accessible to the public. But the most important issue, and the reason I think a lot of our investors do pay, are willing to pay that second layer of fees, is we're handpicking these. And if you look at an 80-20 curve, you can Google this. You'll probably find it from a guy named Perry Marshall. He's done a lot of research on this. The 80-20 curve is a skew curve. Like, you can think of a bell curve in your mind. Well, a skew curve goes like this. It's like I don't know if it's hyperbolic or what, but it goes up and to the right. And so that means that somebody in that top 10% is way higher, way safer, and way higher return than somebody in that 50th percentile. So our theory is that the average investor is going to pick the average operator and get the average outcome. And that's what average means, I guess, that makes sense. But if we can pick in that top 10% or so, then our outcomes will be much, much safer, more importantly, and almost as importantly, higher returns. So if we're getting outsized returns, our fee is more than washed away in the mix there. Does that make sense?
Yeah, absolutely. I mean, what you're saying here is that, if you want to look at it from a fee standpoint, certainly, an investor could, they would pay less in fees if they went elsewhere, right? If they went maybe to direct to a syndicator or an operator. But what you're talking about, your model is set up, one, to identify unique opportunities that they probably couldn't access by themselves. You gave that one example of a deal where you basically were the only, capital that came into that deal outside of another investor in their private network. So that's a deal that they wouldn't have had access to otherwise. On top of that, just when you look at that 80-20 curve, the top 10% really are delivering outsized returns to the rest of it. So if you can identify those opportunities, you're going to be able to deliver outsized returns for those investors and mitigate some of the risk as well in that process. I want to talk a little bit more about who this is ideal for, because I'm always curious when it comes to investors and kind of their psyche and the journey that they're on. Like, when you're talking to your investors, like, what does that archetype look like? Is there a certain type of person who says, hey, you know what, this is the kind of investment I want? I mean, I'm sure you get all sorts of types of people, but like, who is that sweet spot investor that this is ideal for?
Yeah. I was talking to an oral surgeon in the Pacific Northwest, and he was excitedly telling me at the beginning of the call how he was building his retirement by building a portfolio of 20 pretty nice rental homes. And when he got to 20, he was going to quit his job, and his wife was an orthodontist, and she would keep her income. And then he started sounding sort of discouraged. He said, yeah, but I'm getting tired of talking to painters between dental appointments and screening tenants in the evening. And then he leaned in and he said, I got to be honest, I'm only on my third house. And that's why he called me, because he realized, this looked great on HGTV, but it's really hard to pull off. And so our archetype for this is really somebody who has a full-time job, a career, a family, a life, or even a retirement, and they don't want a second job. They realize, hey, I love real estate. I love the tax benefits. I love the income and growth. I don't really like to be in Wall Street's casinos. And I I really want to do this on the side. And they quickly learn, when they get that 3 a.m. toilet call, or when they realize they're spending their evenings, weekends, vacations, lunch hours trying to pull this off, that the stress and the toll it's taking on their life and family is just not worth it. And they're often not getting the returns they expect to get. So they decide, hey, I want to be in real estate. I want to do it a different way. I want to have somebody else manage it for me.
I love it. So many people unfortunately have to go through that process the hard way before they realize, myself included. I remember I wrote a post on LinkedIn about it, but I remember there was a day we had just two properties with 5 units, right? Starting to slowly scale this portfolio. And I remember I got a quote for painting on a unit turn. And I was like, I'm not paying you 700. This is probably 10 years ago. It was like $700 to paint this unit. I'm like, you guys are crazy. I'll do it myself. Well, I was a full-time professional. I had 2 kids who were, one was a newborn. I think the other one was still in diapers. And I decided to do this myself. So here I am. The one day I get off in the summer, on a Saturday, I decide I'm going to spend my time painting this unit. And if you paint the right way, I mean, you're talking about scrubbing the wall. You got to patch holes first. You got to do all this work to prep the walls. You got to do your primer, your layers of paint. I mean, I was literally sitting there watching paint dry, and my wife FaceTimed me with my son, and they were at the beach. And I just realized, oh my gosh, I'm doing this wrong. I
Yeah.
signed up for a part-time job when I thought I was investing.
Yeah.
And that was really that first aha moment that, you know what, there's got to be a different way because this is not what I plan on doing. And to your point, at that point, I was still nowhere near my investing goals. So I'm like, I can't 3x this or 5x this. Are you crazy? So I think for people just to learn and hear that there's nothing wrong with passively investing. Like we all love real estate. We know real estate has the means to help you reach your financial goals. Pick the strategy that makes sense based on your current environment. If you have a full-time career, if you're making good money, if you don't want a part-time job, strongly consider investing passively. Wellings Capital has some great products there. And if you want to learn more, you can go to his website. You can go to wellingscapital.com/resources. Hey, Paul, before we go to our round of insights, one thing I wanted to get into was just kind of where you see things going forward, right? We talked to you 5 years ago. We've got a new president in place now. We've got a lot of, turmoil, if you will, in the economy, or at least the perception of what's going to happen. How are you looking at the market, and what's your investing philosophy kind of moving forward?
Yeah. I don't, I don't want to be a smart aleck and say like everybody does, I don't have a crystal ball. But Peter Lynch from Fidelity did say those who live by a crystal ball are destined to eat glass. And um, I, uh, I, I like to look at what is controllable and what's not controllable. I can't control what's going to happen in the economy. I can't control interest rates. I can't control tariffs. I can't control, the next election cycle. But I can control what I invest in. I can control, the amount of debt and the type of debt on the properties that I invest in. I can control where we invest in the capital stack. Like for example, preferred versus common equity that is going to produce a significantly different risk profile. Just like debt is much lower risk, of course, usually lower return. I can control a lot of things, and I like to stay with the things I can control, and I like to continually outsource, like as we talked about already, the expertise to others. Charlie Munger, God rest his soul, said, "Why would an average person think they can make great investments and beat the market? They don't build their own lawnmowers or design their own egg beaters, do they?" And I like that quote. And I really want to continue to find people that are much, and I don't want to say much smarter than me because that's not the point, but much, much more experienced than anybody on my team in very specific areas, whether it's self-storage, mobile home parks, etc. I want to partner with people who've been doing it for decades, who know it inside and out, and they have an ethical, they have a history of treating their investors well.
I love it. Paul, we're going to transition to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the Mastermind button today. Give me a failure or an apparent failure that sets you up for later success.
I thought we only had 45 minutes. John, were you on my podcast? I had a podcast called How to Lose Money. And we actually, about the time you and I met, I think we were finished with it. But we interviewed 238 investors and business owners about their pain and failures and losses on the way to the top. One of my early ones was in the year 1998. I had just made a good amount of money selling my company. And I heard from somebody that this guy in Charlotte was creating 3% returns for his investors per month by doing some fancy currency trading strategy. And he couldn't explain it. And he wouldn't explain it. And again, I'm going back to Charlie Munger. Charlie and Warren said, we have if something's too hard to explain, we just pass. We're looking to step over 1-foot hurdles rather than try to jump 8-foot hurdles. And I thought it sounded great, even though I did very little due diligence on it. I put in $100,000 remotely, and then I actually drove down to Charlotte to meet with the guy to give him a check for another $100,000. And I just got a funny feeling, and I decided not to do that. Just a few months later, the FBI busted him for a Ponzi scheme. 2,000 investors, $18 million he had offshore. He never told anybody where the money was, even though he's now in year, I think, 24 of his 158-year prison term. And, it just showed me, again, if something's really, really complicated and it's exciting, it's probably not necessarily the best investment.
Paul, I appreciate you sharing that story, man. I think it's really helpful for people to wrap their heads around. And obviously, we talked a lot about passively investing, but making sure you are understanding the investment and the person you're backing. So really great insight. Appreciate you sharing that story there. Give me a digital or a mobile resource you recommend for our listeners.
A lot of people know about Slack. I resisted Slack for a long time because I thought, I'm already checking emails and texts and all these different places. But Slack's been a really, really good, helpful tool for our internal team. So I recommend that. I also recommend something called Voxer, Voxer. It's a quick walkie-talkie type thing. Like if I have 3 minutes between the end of this podcast, for example, and my next meeting, I can dictate into Voxer and just treat it like a walkie-talkie to give my assistant several different things that I need, them to do. And I really like both of those. Now, Slack has a Voxer type feature built into it now. So if you're using Slack for your team, use the audible function. It drives my team crazy, but it's great for me.
Give me the book you recommended or gifted the most in the last year.
Well, I happen to have it right here, John. It's called The Unsold Mindset by Colin Goggins and Garrett Brown. I don't know if you've heard of this, but these guys are USC professors, and they do a sales class that's extremely popular. I think it's in their MBA program, but it's for people who are going to go into the private equity realm. And they basically teach you to sell if you don't like sales, or at least by nature. If you're the type of person who's not slick, if you're the type of person who doesn't, have 5 ways to close a deal, if you're the type of person who just really is not oriented towards sales. But here's the thing, I am oriented towards sales, and I love this book as well. It's a just a great book. And one of the key takeaways from the book is loving people. I think we were designed to love and be loved. And they have a chapter 5, about loving your prospect and loving others. And it's just very, very powerful.
I love it. The Unsold Mindset. We'll have to check that one out. Paul, give me a daily habit that helps you stay focused on your goals.
Yeah, I mentioned that I think we're designed to love and be loved. And one of the things I do every morning is I spend an hour or more meditating, praying, reading ancient scripture texts, etc., journaling. And I really try to start my morning every day off with that. And that helps me get set for the day, helps me, stay calmer. And it really, and I often get ideas that I'm not even trying to think about at those moments that really are creative and very helpful for our business and our life.
I love it. Hey, give me your number one insight for thinking like an investor and not a speculator.
Haha. Well, I really think it does go back to that excitement versus boring. It doesn't sound the way you told the story, John. It doesn't sound real exciting to be painting a unit while your family's at the beach, but it's easy to think that it is. I think it's easy, especially for entrepreneurial people, to romanticize. Oh yeah, I watched HGTV and I saw Chip and Joanna, he's bashing out that wall and and all that stuff, and it looks really cool. It's not. It's actually so much better to stay in your lane, stay focused. Another book I would have recommended, that I've recommended for years, is called The One Thing, and by Jay Papasan and Gary Keller, and it says, stay in your lane, stay focused on one thing, put blinders on, say no to 1,000 distractions, and let the experts do what they're good at. You become an expert in your thing, and you let others be the expert in theirs.
I love it. Let's go a different direction, Paul. You're in Lynchburg, Virginia. Give me your favorite place to grab a bite to eat.
We don't have a whole lot of great restaurants here, but one is called William and Henry, and it's in the basement of a high-end hotel in town, and it is really, really good. But I will tell you one more thing. I just thought of this. I for the first time ever, I made reservations for Valentine's Day a year in advance at my favorite restaurant. So I'm going to be taking my wife for Valentine's Day on Friday, and pretty impressed with the fact that I thought of it a year in advance. What happened is, of course, I called the day of Valentine's Day last year, and they laughed at me. So I said, "Okay, put it on the books for a year from now."
I love it. Hey, we'll clip that last part out. Okay, she doesn't need to know that. we could just say you were thinking ahead. All right. I love it. Hey, Paul, great stuff, man. Always enjoy talking to you. A couple of things that stood out from our conversation. One, you talked about being that investor and not a speculator, and I think so many people miss that, especially when they're early in their investing career. But the key here is making sure your investment, your principal, is backed by income producing assets and not just the speculation of what may happen in the future. So I love that aspect. You talked about also the challenge with multifamily and why I went from the perfect investment or the ideal investment to really a good opportunity, but you had to make sure you understood the speculation side. You talked about your transition focusing more on the fund and being able to cherry pick opportunities, focusing on that 80-20 curve and getting access to deals and opportunities that investors wouldn't be able to access by themselves. So I love that aspect of it. And then the last thing we talked about here was really just understanding how to get involved in deals and opportunities, controlling what you can control, not really worried about the things we can't control in the market and the economy. So making sure that you focus on your investments, making great choices, and selecting the right people to invest with. For folks who want to learn more, I know you've got some resources on your website. They can go to wellingscapital.com/resources, and we're going to put a link to that in our show notes. Paul, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch, and I hope you have a great day.